Thanks so much for tuning into Talking Point. I'm your host, Neeraj Shah. Well, it's been a while that we've spoken to Deven Sangoi. He's changed houses and now is the CIO of Canara HSBC OBC Life Insurance. But he joins us after a really long hiatus to talk about his thoughts on how is he looking at the markets currently and the different factors impacting it. Deven, good having you. It's been a while. Thank you so much for joining
Good
in.
morning, Neeraj. Thanks for giving the opportunity.
No, the pleasure is ours, Devin. So, Devin, tell us from all the years that I've known you, you look at various factors, marrying both global and local, and the macro in particular. How are those factors looking currently as we rested near about 15,000 on the indices?
So what we have seen is that I think the unprecedented stimulus coming from coordinated stimulus. I think after 2008 we have seen first time and global coordinated stimulus to fight coronavirus and the kind of recession what we would have gone into. And I'll just give you a brief point. Like US did less than 6% of GDP for 2009 post Lemon, and right now in 2019 US did around 25% of the GDP as a stimulus. So that's a very big number, and that's not only US. Few other large global economies have done between 15 to 20% of GDP. So it's a huge amount of stimulus which has gone in. uh, Obviously economic activities were restricted, and that's why a large part of that money has gone into the liquid assets like stocks, commodities, everywhere. So though we look at the markets have gone up, but if you look at the kind of interest rate environment you are in, I don't think so we are overvalued. You're fairly valued at 15,000, but there is a lot of room for a volatility at this level. But essentially, what I feel till the time, and the Fed has been consistently talking about, till the time the economy normalizes, we will use each and every to ramp up the economy. Unemployment rate is still at 6%, not 2-3%. So we have a long way to go. We'll go through a phase of volatility, but equity as asset class still looks relatively much better place than any other class.
Devin, one common refrain that has started to come up is that we might see the return of the economy in the world markets in general and India as well. And that might actually not be as good for markets because rates might move up, so on and so forth. Now, that's a strange space to be in, right? 2020 economy went nowhere, markets went up. Now people are saying economy will bounce back, and that might be negative for markets. So my question to you is, how do you therefore position yourself in equities if you indeed believe that equities is the best asset class even now? Would you change themes, etc., or would you be defensive in nature? Because from the looks of it, unless something dramatically changes, the economy is likely to bounce back.
So what we are seeing is everywhere there is a trade which is going on, and obviously the economic data globally are coming very good. Not only in India, India is already out of recession, and we are seeing everywhere the rate. Like for example, U.S. unemployment rate was almost 12%; it's come down to 6%. We are seeing across the board improvement. Though the market is worried about interest rate, going up, but I think initial phase of recovery, as the recovery starts gaining in, there will be some kind of increase in rates, but rates are not going to go very far off from here. Inflation near term has come from commodity, and that's also as worried market. But there are supply chain disruptions which have happened, and these disruptions have led to increase in commodity prices or few of the shortage of material. But these will even out as we move forward. So I don't think so that inflation is going to be so strong and is going to get into. So markets, what we are going to see that you need to be. It's been a very broad rally across the world. Each and every asset class has moved up, small cap, mid caps. But henceforth, I think what we are changing is where we see the sustainability of earnings. So partly where we see the earnings will sustain and the business will continue to gain market share, especially in India. Few of the sectors after coronavirus lockdowns have really bounced back, and at least they continue to gain market share. They continue to have good visibility of earnings. Second is part of the value also we need to look at. I think as there's been a strong first time we're seeing in so many years a push for sort of a divestment, and if we've been waiting long for last 2-3 years that something will happen, I think this year if government does one divestment, then obviously the PSU space looks very cheap, and it can really give much higher return, and belief of value returning and giving returns has been last 5 years where value has underperformed significantly against growth. So I think we need to be a bottom up now. We need to look at the spots where the re-rating is possible, and still you can get a much better return than debt or any other asset class.
Okay, now just before we get back to India full steam, Deven, a word on the volatility, right? Global markets. The yields are causing a headache to a lot of people. I mean, off late, we've seen the Chinese markets go through multiple bouts of extremely high volatility. That 2% move seems to become a norm for the Chinese markets. How much of a part do you think the global volatility will play on the Indian bourses over the course of the next 6 months? Will we tide over them smoothly, or can there be cases wherein the Indian markets, led by the global moves, could experience extremely sharp swings?
So this is a coordinated global move. So initially what we will see that the volatility will hit us, and I don't think so we can be spared of the volatility. But if you see for past 10 days or 12 days, the volatility is hitting more of a Nifty, not below Nifty. I think if you look at a mid cap index or small cap index, they've been too indifferent to what has happened to the larger market. So I think larger caps where the flows have been higher and the ETFs have invested and the large investors have invested, that will go through much more. Stock specific, we have still seen that the stocks have done pretty well. So my view is that we need to look at stock specific, and there will be a volatility, and we need to go through the volatility.
Okay, so let's try and focus on that a little bit. A lot of, not a lot, a few people who are talking about playing cyclicals and value, or rather playing cyclicals and not necessarily the high PE names, are talking about financials as being the center of all of this activity. There is a belief that valuations are not overly stretched, and whatever part of the cyclical economy goes back, financials will play a part. One, do you subscribe to this, and therefore are you overweight financials? Two, what portion of financials are you overweight? Because again, I think today there was a report which said that by virtue of the kind of liquidity that exists and the balance sheet strength, banks would be better positioned than NBFCs. What's your thought here?
So I would say that I agree with the thesis that financials are going to be a better place to play recovery, because you're going to see a broad-based recovery. The reason why financials look better even in India is that you've gone through multiple episodes of stress. First was Demon, then ILFS, then GST, and now Corona. I think we withstand a lot of churn and stress in the financial system before anything happened globally. And here, what we have seen, the corporate banks, which has been, through the stress, corporate stress was pretty high when we consistently cleaned up the system. We have seen that last 2 quarters, they've really shown a resilience despite of whatever has happened. So financials look very good. Within financials, banks look much better. The reason what I said is the corporate banks are much more better placed, and we've seen a huge amount of resilience from them. They are getting back on the growth path. They don't have baggage of stress. I wouldn't say that NBFCs are not better. I think you need to pick up bottom up which NBFC, which sector. So we like CV financiers and few of the bottom up NBFCs. So I think where we have seen ability to withstand the stress, balance sheet which are strong, and heavy provision has been done, so that if unforeseen circumstances, you have cleaned the balance sheet, so you're back on growth path. So I think overall financial space looks very, very good.
Then the other overarching belief, not overarching really, but a select belief is that by virtue of creating the bad bank structure plus the national infrastructure piece that the government announced in the budget, there is room for PSU banks to park a lot of the toxic assets in the bad banks and virtually become not corporate lenders but retail lenders of sorts. And with the cost of money that they have or the cost of funds that they have plus the network that they have, they might actually be able to put up a fight, which has never happened in the last 15, 20, 25 years of privates taking over market share from PSUs. And that alone may help in valuations too. What is your belief here?
So if you go by the cycle, I think whatever government is doing, you know, bad bank, national infrastructure, all is good. But you look at the cycle, go back to 2003-4 when the wider economic recovery happened. Before that also there was a stress between 1997 till 2004. And we have seen that PSUs were badly impacted. And when the longest recovery cycle, which happened between 2004 to 2008, 5 years of economic expansion, these banks really recovered a lot of it. This bank grew and they were re-rated significantly. I think we are getting into a phase like that where we have seen the larger part of the stress is in the books. We have seen the only thing which has been holding them is the capital requirement. And in some of these steps taken by government, if they inject capital or they are able to raise capital out of the capital market, I think they should be back on growth phase and they are significantly cheaper. As I mentioned, that PSU space has a lot of value. We just need a trigger and the growth coming back or some unlocking of the value we will be able to see. So we need to be stock specific out there, but PSU banks can be a real multi-bagger if some of the reforms go through and they back on the growth path.
Okay, I'll talk about PSUs in a bit. Deven, since we are on the topic of financials, a word on insurance, and you would know this business inside out. Now, I would want to understand from you what's your vision about what could happen to the insurance space. You know, we were looking at this chart in a Goldman Sachs report which came in the month of February. They've compared the size of some of the insurance companies currently to LIC's size in FY01. And then they are looking at, this is the chart. And this shows how LIC over a 20-year period has grown at a 15% CAGR. The argument that this chart probably throws up is that can the privates do better than LIC and therefore over the next 15, 20 years grow at higher than 15% CAGR? And if that is indeed the case, is there money to be made even in some of the expensive insurance plays? Now, I'm throwing this wide open to you because you understand the business so well. What's your sense about how to play the India insurance story?
So if you see the number of listed players over the period of time have gone up and they have created huge value. Obviously, this India is an underpenetrated market. We have seen private players growing at higher rate. LIC has done very good job, but the private players also have increased distribution, offer much better products or variety of products. So I think as the competition comes in, the market is finding new kind of product. You are seeing growth in term products. You are seeing growth in annuities. So there are various kind of products which are coming in the market. Market will grow. And I think what we have seen is that need for insurance in Corona-like environment has really gone up because awareness that you require to be insured has gone up. So we are going to see as the GDP growth goes, as the awareness for such product goes, and financially literacy goes up, you're going to see the increased penetration happening. We have very strong companies which are listed, and each of has their unique advantages. Some are bank based, some have been really good. So I think we've got very good companies and they will create a lot of wealth as they've created, and they can grow between 12 to 15% compounded over next 5 to 6 years.
And is that good enough to, from a shareholder perspective, to create wealth? Because one of the arguments against them is that they are priced to perfection for, I mean, taking into account the next 2-3 years growth, at least, if not longer. Do you subscribe to that, or do you believe these high growth companies will stay expensive?
See, this business has a lot of entry barriers, and some of them have created a very good niche, and it's very difficult to break that. So in India, some of these business have very good management, very good distribution, very good product suits, and they have continuously innovated. So I think a good business in India has never got cheap. You never got HDFC Limited cheap, or you got a bounce of some volatility where the uncertainty is highest. But good business, it is very difficult to replicate a good business in India. And the reason why they are expensive is that if you see globally, insurance industry is growing at a couple of percentage point, maybe 2-5%. Even in Asia, growth rates are coming down. The industry is becoming mature. But in India, you have a headway to grow. So if you can grow and you have a good management, good business, good entry barriers, obviously you will get a premium.
Okay, so you seem to be of the belief that there is headroom for growth here. Okay, that's great. Just the other question, Deven, is on PSUs, and I would want your thoughts here. You mentioned privatization. I think there are firm steps being taken, right? I mean, if you just look at the trajectory at BPCL, the treasury stake sale done yesterday, Numaligarh refinery resolution a few days back, all of them point towards walking on the path of probable divestment. Now, what's your sense on all marketing companies? They virtually have a moat around their business. Maybe a player or two might get in, but it is a strong moat around the business. It's a business that will arguably grow unless EVs become really, really big very quickly, which might not happen. What's your sense around what kind of value unlocking could happen in the oil marketing companies if indeed a BPCL does get privatized?
So I think we've been waiting long, last 3-4 years, to this to happen, but it's been a long wait. I hope this year government does that, and it will be a very bold step in terms of showing the agenda of reform. I think it's a big bold statement from India if that happens. And I'll give you going back to past when IBP was sold, the marketing companies got re-rated significantly, and this was happening in 2004, so 3-4, where we have seen the unlocking of value. These companies have immense amount of assets, very high entry barrier. They have pipeline, they have distribution setup, which are unmatchable. And to move from a petrol diesel to EV, I think it's still a long journey. And you don't need to see that they have been doing a lot of things. Like a few of the BPCL pumps have been, having a retail outlet. So like what happens globally, we have seen a lot of things happening. So unlocking of value, they are still cheap. And we have seen that any good assets which been privatized, I think from there also we investors have made significant amount of wealth because they're so cheap, and once they get into a better management, the unlocking of value is far ahead of what you have expected.
Okay, now Deven, let me ask you a question. I was asking about a few themes myself. Can I ask you, where is it that you have the strongest conviction over the course of the next 18 to 24 to 36 months, where you are positioning your portfolio, not from a near 6-month perspective, but you believe that over the next 2-3 years, significant wealth creation can happen?
So I think one, I told you financials. I think we're just getting out of the cycles, especially corporate banks, after a long drawn cycle, and we have tailwinds favoring them. You don't see corporate stress. You have seen especially a big revival in steel and other infra industry. The real estate volumes are showing. So there's a big deleveraging which is happening in such industries. So that's where most of the stress was there 4-5 years ago. And we've seen in last cycle when this cash flows coming and the stress gets reduced, then you have multiple triggers coming in for the earnings. What Corona has done is provided additional buffer of provisions, and that's good enough now. So I think we're going to see 2-3 years very good growth momentum and a big re-rating in financials. The second part, as I mentioned, I think it's been a big, long hope, and the value investors. I think PSU is a space. If some of at least one or two divestment happen this year, that will be a big statement. I think they are fairly undervalued. If you look at dividend
But
yields,
what within PSUs, Deven? Because that's a wide basket. So what within
it's a
PSU?
wide basket. So you can look at few of the metal stocks, few of the PSU banks, as I mentioned, few defense companies.
Okay.
See, we've seen a lot of places where there's a monopoly. There are logistic companies which are monopoly. There are defense companies which are monopolies. So there are a lot of monopolies. When some of these monopolies get privatized, I think you're going to see a huge amount of value creation happening. So as a space, it's a hope. We've been hoping that some time, and they have underperformed big time. So what we are saying to say is that they have got dividend yield, they've got every tick mark on value. You just need unlocking trigger.
Okay, Deven, last question. What perplexes you? Is there something that you believe that you can see in plain sight, but the market can't, or something that baffles you as to why is it that the market giving so much of value to this, wherein you find it baffling that the growth rates are not there? Is there anything where you are at complete loggerheads with what the market is doing?
Not right now, but I think once I see is the consumer space. I think last 5 years we have done very well. They've delivered best of the returns, but the growth rates are slowing down and the valuations are. I won't say the entire space, but I would say where the growth rates are going to come down and the valuations are steep. That's the place where you will see relative underperformance may continue on longer than what we've seen.
Okay. Then it was a pleasure talking to you today. Thank you so much. It's been a while, but look forward to have you more often on this forum.
See you soon.
Yeah, thank you. And viewers, thanks for tuning in to this edition of The Talking Point.